Welcome to the deep dive. Today, we are focusing entirely on the 2025 tax year updates and specifically the opportunities you really can't afford to miss.
Right. We're looking at a huge new piece of federal legislation, the one everyone's calling the Modernization Act, plus some really crucial updates to existing benefits.
And our goal here isn't just to, list off a bunch of numbers. We want to give you a complete strategic playbook.
We're going to show you where to look, what documents to save, and really how this all affects your financial planning right now, not just next April.
Okay, let's unpack this.
So to start, I think we have to nail down the terminology because it really informs every single decision you're going to make.
Deductions versus credits.
Exactly. Deductions and credits. A deduction is powerful for sure.
Mm-hmm.
It reduces the amount of your income that's actually subject to tax.
So if you make, say, $100,000 and get a $10,000 deduction.
You're only paying tax on $90,000. It can effectively lower your tax bracket.
And a credit, and that's where the real leverage is, right?
Precisely. A credit cuts your tax bill, dollar for dollar. So if you owe the IRS $3,000 and you have a $2,000 credit, boom.
Your bill is cut by 2/3.
Instantly. And the absolute game changer, the thing to really watch for is the refundable credit.
Because
That's the tax equivalent of finding gold. A refundable credit can get you cash back even if your tax liability is zero.
you don't even have to owe taxes to benefit.
Not at all. And we're going to see that with the adoption credit. That shift to refundability is probably the most important development in tax policy for families this year.
Okay, so let's start with the largest structural changes for 2025, the ones coming from that huge new federal law.
The Fiscal Responsibility and Modernization Act.
Right, and the first thing it does is boost the foundation for millions of taxpayers,
Hmm.
the standard deduction.
It does, yeah. The standard deduction is like a baseline shield for your income. And these amounts are getting a pretty significant increase for 2025.
So what are the new numbers?
For those married filing jointly, it's now $31,500. That's up from $30,000.
Okay.
For a head of household, it jumps up to $23,625.
Mm-hmm.
And for single filers, it's going to be $15,750. So that's a pretty powerful change right off the bat.
And here's where it gets really interesting strategically. I mean, historically, if you took the standard deduction, you kind of stopped there. You didn't worry about receipts or deductions.
Right. We're done.
But this new act introduces these big new breaks that are available for both itemizers and non-itemizers. It fundamentally changes things.
That is the core takeaway. I mean, if you're one of the millions who just ignored tax-specific record-keeping before, you now have a massive incentive to save every slip, every log.
Okay, so what are these new deductions?
There's 4 major ones, and the first 2 are aimed at earners. First is the qualified tips deduction.
Okay.
If you work in a tipped occupation, a server, bartender, and you report your tips, you can now deduct up to $25,000 of those reported tips.
Wow. That's substantial relief. It really tackles the tax burden of reporting cash income.
It truly does. Now, there are limits. These deductions start to phase out if your income gets too high.
The MGI.
The MGI, your modified adjusted gross income.
Yeah.
For this tips deduction, that phase out starts at $150,000 for single filers or $300,000 if you're filing jointly.
And what's the second big one?
The qualified overtime deduction. This one targets the premium pay a lot of workers get.
Can you break down which part of the overtime pay that actually applies to?
Absolutely. So under the Fair Labor Standards Act, employers have to pay time and a half for overtime. This deduction only applies to the half part, the premium.
Not the regular hourly rate.
Exactly. So if your base pay is, say, $20 an hour, your overtime rate is $30. The deduction applies to that extra $10.
And how much can you deduct?
You can deduct up to $12,500 of that premium portion or $25,000 if you're married filing jointly. And it uses the same income phase-outs as the tips deduction.
So if I'm a worker who never itemizes, I'm suddenly keeping all my pay stubs to track this stuff for the very first time, which makes me ask, why wait until April 15th to benefit from this?
That is the pivotal insight. You shouldn't wait. Since these are available now, you should be adjusting your withholding.
Today.
Right now. You're basically giving the government an interest-free loan all year by over-withholding. The IRS has already updated the W-4 forms deduction worksheet for these.
So you can go in and immediately get that cash back in your paychecks.
Yes. That's cash for bills, for savings, not just a bigger refund next spring.
Excellent point. Okay, moving on to the third new deduction, the car loan interest deduction.
This one is aimed right at the consumer market. You can deduct up to $10,000 a year for interest paid on a car loan.
But there's some specific rules here.
A few, yes. The loan has to be taken out in 2025 to buy a new passenger vehicle.
And there's a requirement about where the car is made, correct?
That's right. The intent is pretty clear.
Yeah.
It's to incentivize domestic assembly. The vehicle must have been assembled in the U.S.
And you have to provide the VIN, the vehicle identification number, on your return.
You do. And the phase-out for this one is a bit lower. It starts at 100,000 MGI for single filers, 200,000 for joint.
And finally, a specific deduction for seniors.
Yes, the enhanced deduction for seniors. If you're 65 or older, you get an extra $6,000 deduction.
Or $12,000 if both spouses qualify.
Right. And this is totally separate from the existing extra standard deduction amount for seniors. The phase-out for this one kicks in at $75,000 for singles or $150,000 for joint filers.
Okay, that sets the table on the universal deductions. Now, let's pivot and talk about credits that directly address the cost of, building and supporting a family.
The focus here is really on two main credits. First, the child tax credit, the CTC. The maximum amount has increased to $2,200 per eligible child for 2025.
And it's still partially refundable?
It is. A portion of it remains refundable through what's called the additional child tax credit, which is really crucial support for low and moderate income families.
But the really dramatic shift is in the adoption tax credit. The increase in the amount is good, but that new refundability rule, that changes the financial math completely.
Completely. So the maximum credit for 2025 is $16,810 per child. But the major news, the headline, is that it's now refundable up to $5,000 per child.
Why is that refundability so massive strategically? What does that really mean for a family going through an adoption?
Well, it removes this multi-year barrier. Before this, if you had huge adoption expenses but owed very little in federal tax,
You'd have to carry that credit.
for years, sometimes 5 or 6 years, just hoping you'd owe enough tax eventually to use it all. Now, that $5,000 refundable part gives you immediate cash.
Right when you need it for agency fees, legal costs.
Exactly, regardless of your tax liability. So if you had, say, $16,810 in expenses and owed zero in taxes, you get $5,000 cash right away. Then you only have to carry forward the rest.
That's a huge deal. Any other key rules?
You have to file jointly if you're married, and the income phase-out starts at about $252,000.
And we have to contrast that with the Child Independent Care Tax Credit, which, when you look at it, it really highlights a big policy gap.
They're very different tools. The CDCTC is strictly for child care costs for working parents, kids under 13.
And the CTC is for general family support. Groceries, rent.
Right. And the problem with the CDCTC is that it's currently non-refundable, and its benefit levels haven't been indexed to inflation since 2001.
2001.
Yes. So when you have childcare costs averaging over $11,000 a year, and the average benefit from this credit is under $600, and it's non-refundable.
It often provides zero benefit to the lower income families who need it most.
Because they don't owe any tax to offset in the first place.
So if that credit is basically useless for a low-income family, what's the better strategic move?
They should be looking at their payroll actions. Specifically, a Dependent Care Flexible Spending Account, a DCFSA. That money comes out pre-tax.
Which lowers your taxable income immediately.
And that's often a far more reliable benefit than a non-refundable credit that might just evaporate. It's a classic case where a deduction beats a credit because of the credit's flawed design.
Okay, let's move on. Let's look at credits that reward long-term financial security and home efficiency, starting with the Savers Credit.
This is the Retirement Savings Contributions Credit. It's a non-refundable credit designed to help low and moderate income folks contribute to their IRAs or workplace plans. It's worth up to $1,000 or $2,000 if filing jointly.
It's good, but the real story here is what's coming next. What's fascinating is how the program is evolving.
Indeed. Right now, it's calculated in these tiers, 50%, 20%, or 10% of your contribution, all based on your AGI.
Right.
For 2025, the max AGI to qualify for joint filers is $79,000. But starting in 2027, this whole program gets replaced by the Savers Match, and that's a fundamental design shift.
From a complicated calculation.
To a guaranteed direct deposit. The match will be a refundable 50% federal matching contribution deposited directly into your retirement account. It's a monumental shift. It simplifies everything and guarantees an immediate impact, taking all the tax math out of it for the most vulnerable savers.
Okay, let's turn our attention to the home, the energy-efficient home improvement credit. This one is still around through the end of 2025.
That's right. It covers 30% of your qualified expenses, up to an annual max of $3,200. And crucially, it has no lifetime limit. You could use this every single year through 2025.
For your main home.
For your existing main home, yes. But you have to track the specific annual caps inside that total. There's a $1,200 limit for things like insulation and windows.
And windows themselves are capped at $600.
Right. Then there's a separate, higher $2,000 cap just for big-ticket items like qualified heat pumps or biomass stoves. You'll need all your receipts and contractor statements for this one.
Finally, we need to touch on two areas where there's a huge gap in federal support, leaving people to navigate a complex state-level maze.
Yeah, this really raises an important question about where you live, because when it comes to renter support and extra adoption benefits, it's all up to the states.
First, renters.
There is no federal renter's tax credit,
Yeah.
first stop. Housing affordability support is totally delegated to the states, and it's a chaotic patchwork.
So what should you be looking for in your specific state?
You need to check if your state offers a credit or a deduction. A credit is better. States like Arizona, Colorado, New York, they offer refundable credits or rebates, often tied to your income or age, to give you actual cash back.
And deductions.
States like Indiana and Minnesota offer rent deductions, which just reduce your state taxable income. It's less relief than a credit. You really have to check the rules for where you live.
And that same strategic confusion applies to state-level adoption support, too.
It does. Even with the big improvements to the federal credit, many states offer their own help, but they vary dramatically. Kansas, for example, offers a credit equal to 100% of the federal amount, but it's non-refundable. Whereas Alabama offers a smaller $2,000 credit, but makes it fully refundable. But only for in-state adoptions. So families have to check both federal and state rules to maximize everything.
So, to summarize our deep dive into 2025, the whole landscape has fundamentally changed. The key takeaway is that strategic shift from the Modernization Act.
Absolutely.
Those new deductions tips, overtime, car interest, the senior one, they're available to everyone, which forces millions of people who never itemized to become meticulous record keepers.
That's the big one.
Yeah.
And it's coupled with huge enhancements in liquidity for families, like that massive change to the adoption tax credit's refundability. The goal should be to turn this knowledge into immediate action.
So what does this all mean? If you realized during our talk that you qualify for the new tips deduction or the overtime deduction,
Or even that enhanced deduction for seniors.
you should not be waiting for a big refund check next April. You should be using the W-4 adjustment process today.
The difference between waiting for a refund and having that cash in your paycheck now could be hundreds of dollars in interest, savings, or investment returns throughout 2025.
So the question is, are you letting the government hold on to your money, or are you using these new laws to immediately improve your own cash flow? That's really the strategic challenge of the 2025 tax year.